Okay, good evening everyone. I think we're going to make a start. Thank you ever so much for all of you for joining us for this webinar this evening. It's the first one of these that the East Anglian branch has done as a webinar, although this is actually the last of our seminar series for the 2019-2020 programme. This is our first one to do on Zoom. So thank you very much indeed for joining. It's lovely to have you all here with us. So throughout the last year, the East Anglian branch has run a number of seminars on a topic of managing environmental change. As I said, this is the last session, and in this session we're going to focus on managing financial risks for climate change in particular. I'm sure you're all sat somewhere pretty warm right now. It's fairly hot in my little room in here, so I think everyone appreciates just what we're talking about when we talk about weather events and extreme climate. We've seen a number of heat waves in recent years, as well as a number of significant flood and storm events. And whilst global attention is obviously currently focused on the COVID-19 pandemic, climate change is not something that's going to go away. And we're dealing with the COVID-19 situation, but climate change is very much something that's going to be with us for a long time, and something we need to be dealing with. In fact, just before the COVID-19 pandemic struck in January, the World Economic Forum released its annual global risk report, which sort of sets out what it sees as the biggest risks for global economy over the year. And it was very much dominated this year by environmental risks and risks associated with not adapting and mitigating climate change. So this is quite a timely webinar, I think, and a timely topic. We're actually going to sort of focus on the managing the financial risk that comes from climate change. And we've got two great speakers with us this evening who are going to take us through two different aspects of this topic. We've got Paul Munday from S&P Global Ratings and Nick Pyatt from Trioss. And we're going to hear from both of them. Paul's going to speak about the credit ratings process and how climate risks are being considered. And Nick's going to talk to us a little bit later on about the insurance industry and how they're responding to challenges of climate change. We're going to have both presentations, and then there's going to be a time at the end for Q&A. So please do type your questions into the Q&A function of Zoom as we go through, and we'll get to those at the end and have a Q&A at the end. If you've got any sort of technical issues around using the webinar or using the Zoom software, then please do use the chat function, and you can chat to CIWEM Learning, and there's someone there who can help you with the more technical side. So if you've got a technical issue, use the chat. But if you want to ask a question to the speakers about the presentations, then please use the Q&A. Just also to let you know that the session is being recorded, and it should be available on the CIWEM website shortly after the event, should you want to listen again or share it with colleagues. Okay, so our first speaker is Paul Munday, and Paul is joining us from S&P Global Ratings, where he's an associate director. He leads research and application of climate change adaptation and resilience analytics, and he has over a decade of experience in developing climate adaptation strategies and plans, as well as undertaking risk assessments both in the UK and internationally, both with public and private sector organisations. So he's got lots of great experience, and he's going to talk to us, as I say, about the credit ratings process and how climate change is considered within that. So, Paul, I shall hand over to you, and you can move on to your slides.
Thanks, Nikki. Just confirm that you can hear me okay? Hopefully you can hear me.
Oh, yeah, we hear you.
Yes, we can hear you, Paul.
Fantastic, good. Thanks very much. Hi everyone. I'm Paul Munday. I'm an associate director, as Nikki said, at S&P Global Ratings, and I'm the specialist in adaptation and resilience. And my presentation is going to focus on physical climate and ESG risks, and specifically how we kind of factor these into our credit ratings, as well as some kind of emerging themes in this area as well. So just kind of kicking off, it's worth just understanding and reiterating kind of what a credit rating is, and equally what it is not. So a credit rating is a forward-looking opinion about the ability of an issuer to meet its financial obligations in full and on time. It incorporates our view on the relative likelihood of default that's applied to entities and securities. And importantly as well, it also considers a consideration of ESG credit factors, which can affect the capacity and the willingness of an entity to meet its financial commitments. A credit rating is not a guarantee of credit quality or default probability. It doesn't constitute investment advice. It's not a measure of price or liquidity. It's not a way of defining good or bad companies, and it's almost certainly not an audit of a company. So what's the objective therefore? So the objective of a credit rating is to provide metrics for evaluating the relative creditworthiness of issuers and their related obligations. And our credit ratings provide transparency about the key drivers of creditworthiness over time. And we rate thousands of entities globally, with many more rating actions in any 12-month period. And our credit ratings as well are used by issuers, perhaps to expand the pool of investors and the available capital, by intermediaries to determine the interest rate that issuers will pay, and also investors to give a third-party opinion of credit quality. Oh, seem to have skipped slides here. Let me try and find where we were. Actually, Nikki, let's, to make it easier, can I just give up remote control and can you just skip to the next slide for me? Thank you. So how do credit ratings, ESG factors and climate risks feature in our ratings? So we incorporate ESG credit factors into our analysis if we believe that the factors are material and they're relevant to our opinions of creditworthiness. And the influence of ESG credit factors depends on, of course, our opinion of how they affect the ability of entities and their willingness to meet their financial commitments. ESG credit factors can influence ratings, rating outlooks, and ratings headroom. And that's the amount of breathing space, essentially, that companies have. And of course, their influence differs across sectors. So where sectors have either greater or lesser exposure to different types of risks, so water stress being a good example. It's also worth reiterating that strong or weak ESG and climate risk credentials do not imply strong or weak creditworthiness as well. Nikki, next slide, please. So this slide gives examples of ESG, including climate-linked credit factors that we use in our ratings. You'll probably be familiar with the difference between transition risks. So those are the risks that are related to our transition to a low carbon economy, and also physical risks. So those representing kind of chronic or slow graduating kind of changes in different events such as mean temperature, and also acute hazards. So high impact, low probability type events. And indeed, it's worth mentioning that because, of course, we've taken into consideration transition risks in our ESG credit factors, so relating to emissions of GHGs, for some time. And many of you will remember, of course, the European Union's emissions trading scheme, or ETS, back in 2007, and that sent ripples through the market, and we actually hard-coded those financial liabilities into our credit ratings back then. Now, what's important here is that the kind of natural conditions factors are typically where we may cite physical climate risks and where they may feature in our credit rating analyses. But we also, of course, consider the country risk and the sector risk as well, because those are important elements. And that reflects the fact that certain countries, particularly small island developing states or SIDS, and sectors, agriculture being probably a good example, are more sensitive to climate risks than others. And I should say as well that the slides that follow do not consider the S&G factors here, just due to purely to time and the topic of this webinar. Next slide, please, Nikki. So, as I mentioned earlier, we rate thousands of entities, including corporates, and we take many more actions over any 12-month period. And this table really just tries to provide a snapshot of the number of corporate credit rating actions that have been driven by ESG credit factors over a 2-year period. And that could be a change upwards or downwards, or it could be an outlook change. So we could recommend that an entity is placed on credit watch where we can anticipate a change in the rating in the near future. And you can see that ESG credit factors, including climate risks, of course, as well, represent a significant proportion of rating actions during this period. It's also worth stating that more recently, regulations have changed earlier this year, and that means that every time that a rating changes due to an ESG factor, which of course can include climate risk, this has to be documented in that release. So between March, so the 30th of March this year and the 20th of May this year, we took nearly 600 rating actions driven by ESG factors. And what this means is that ESG now has a more meaningful and documented impact on credit quality, which is useful to investors and the markets more generally. Next slide, please, Nikki. It's also worth, thanks Nikki, it's also worth stating that credit ratings do not have a predetermined time horizon, and they therefore include consideration of longer term risks. Financial forecasts are typically undertaken over 5 years, which of course gives us high confidence within this time period, but we don't of course ignore longer time frames, and that's particularly relevant for financial instruments such as bonds, which have maturities of 20 or 30 years or more. So we do use longer term time periods where we believe impacts will be material over those time periods. And we rely on the transparency and availability of information. And of course, we do receive confidential information from the entities that we rate that isn't publicly available. And the point of saying that is, whilst using that information that's available and it being transparent, the likes of TCFD makes our job slightly more easy. Next slide, please, Nikki. As I mentioned a little earlier, we incorporate climate risks in a number of ways into our rating, and this is an example of our corporate rating process. And of course, we share our criteria that we consider in the method openly, and you can read more about this online, but I don't have the time to go through it in detail here. But suffice to say, many countries, of course, regions of the world are less or more exposed to extreme weather events. So, you know, hurricanes that we see on the east coast of the US and in parts of Asia, heat waves in the west coast of the US, Russia, and also sub-Saharan Africa as well. But we can also adjust the industry score due to physical risks. For example, where we perhaps believe that the industry profit margins are likely to be impacted by severe drought or flooding. And I've got a few examples a bit later. So both the country level and the sector level risks, where we believe them to be material, are factored into our credit ratings alongside those impacting the entity itself. Next slide, please, Nikki. So I've mentioned TCFD briefly, but it's worth just spending a couple of slides focusing on it. So TCFD is helpful for a number of reasons, but most importantly, it places emphasis on companies to assess and disclose financially material climate risks and also opportunities, and how these risks and opportunities are expected to affect a company's income, their balance sheet, and their cash flow under different future climate scenarios. Next slide, please, Nikki. The recent TCFD status report that was released last year had a number of findings. So first of all, the kind of number of disclosures is increasing, although there is some way to go, and we are seeing more granularity in terms of the data that companies are sharing, and therefore we can understand better how companies are preparing for climate change, which is of course positive. Where disclosures are made, more clarity is arguably needed. The use of scenario analyses is growing, but there seem to be less insights available as to the impact of scenarios on company strategies. And also the collaboration and the integration of multiple functions across companies and their supply chains is fundamental to understanding that kind of value chain of risk. So whilst TCFD is voluntary at the moment, there is some kind of rumblings and expectations that it will become a mandatory requirement in the future. And indeed, we've started to kind of see this in the UK, where publicly listed companies and asset owners are expected to disclose climate risks and impact data by 2022 under the government's green finance strategy. And of course, the upside is that the information that companies disclose will be of use to financial and non-financial actors, including credit rating agencies like S&P Global Ratings. Next slide, please, Nikki. So these next two slides show examples of rating actions that we've taken related to climate risks against each of the e-profile factors that I shared in the previous slide. And you'll notice that we've taken rating actions relating to climate risk for over a decade or more, where, in our opinion, climate risks were deemed to impact the creditworthiness of entities that we rate. So, for example, we've taken actions related to exposure to transition risks, so specifically coal-based power generation, which of course resulted in a downgrade, a lowered rating. We've also reacted to exposure to regulatory costs linked to water leakage, which has also resulted in a downgrade. But we've also raised ratings as well, and it's worth reiterating that where we see entities taking positive steps to reduce their exposure to risks, including transition risks such as liabilities related to coal, we take that into consideration as well. And there's an example at the bottom of the slide here. Next slide, please, Nikki. This slide shows some more examples, and we've lowered our rating, which is another example of back in 2017 of Aberdeen roads, and that was due to flooding, and the flooding delayed the construction activity of a major project, impacting delivery of that programme of work, increasing liabilities of the entity and credit quality. We've also taken rating actions related to extreme weather events that have caused service disruption, PG&E being a rather famous case relating to kind of hurricanes and wildfire risk. But we've also taken actions at a sovereign level as well. So the Turks and Caicos Islands experienced some quite severe impacts on GDP, specifically in 2018. And there's an example on screen. And there are many, many more not listed here, of course, as well. But that should just give you a flavour as well. Next slide, please. So needless to say that our climate is changing. The impacts of climate change, of course, will be different under different warming scenarios. And of course, many, if not all of you, will be familiar and aware of the Paris Agreement target of 2 degrees. And at the moment, the UNFCCC suggests that we're likely to hit about 3.5 degrees based on countries' nationally determined contributions, or NDCs. So that's kind of the actions that they've pledged to take. We could even see 5 degrees or more by the end of the century under more extreme scenarios. And of course, under those more extreme scenarios, we see the impacts quite vividly. For entities that we rate, it can help for them to think about future scenarios, scenario planning, and to apply scenario stress testing. And that really helps them understand how they may be impacted, and or indeed their response, and equally the actions that they may need to take by way of adaptation going forward. Next slide, please, Nikki. So this slide captures, on the back of that, the kind of growing costs of kind of climate risks and also the adaptation gap that's forming. We are kind of massively underspending in terms of the adaptation projects that we need, and that gap is growing. So companies essentially are having to spend more money to improve resilience and reduce their exposure. And the upward trajectory on the left-hand side also shows that the costs have increased, and we can expect a similar pathway in the absence of significant investments in adaptation. The right-hand figure makes the point that the difference in investments in adaptation are exponentially different under each warming scenario. So using the example of coastal assets, such as power stations that obviously draw quite a lot of water, against the amount of adaptation finance that is needed. So in short, what we're trying to say here is that the case for investments in adaptation is quite a strong one. Next slide, please. So we are working to get a better picture of our ratings over time using our analytical power. So we have various experts in this area, including our colleagues in Trioss, who have developed a physical climate risk tool, and this tool takes over 500,000 data points from over 15,000 companies. And it shows essentially where assets may be impacted under different climate scenarios and over time. And I've got an example on my next slide. And really, we're working to draw on enhanced climate risk analytics and incorporating these insights into our credit rating process and our analyses, because from a credit perspective, rather, this will help us identify where effort is also needed to adapt. Next slide, please, Nikki. So how do we better understand exposure to physical climate risks using enhanced analytics? So our approach is to map climate hazards across the globe, where the value in each climate risk represents the level of risk for each hazard at a particular time point and scenario, or RCP, so representative concentration pathways for those that are more familiar with the terminology. Our physical climate risk scores are ranked from 1 to 100, so low to high. And as an example, this graphic shows the heatwave risk for a global energy company that is based in Europe, but with operations all over the world, which is quite typical for those types of companies. When we overlay the company's assets with heatwave risk, we see that some sites are at a relatively high or low exposure to heatwave risk. And we can do the same for other hazards, including cold waves, drought, storms, wildfire, sea level rise, and flooding as well. And we score an entity's assets for each of the 7 hazards, and we identify the most at-risk sites. We may also gather additional information to gain greater insights of impacts at the asset level as well. This type of analysis can help us to answer questions such as what might be the impact on the company if these high-risk sites were to be out of action for a period of time, what proportion of the company's assets are exposed to different levels of climate risk, so whether that's high, medium or low, for example, or indeed, what are the most significant contributors of that kind of physical risk score. So we can bundle all of those scores together against each of the 7 hazards, and we can understand which is the kind of greatest driver of risk for a particular entity or sector. And our analysis can look, of course, at whole sectors or bespoke portfolios comprising multiple companies to understand risk exposure at a sector level and also on a peer comparison basis. Next slide, please. The spatial dimension of risk is also important as well. Indeed, many of the impacts of climate change and extreme weather events are place agnostic. So, we see impacts affecting multiple sectors and entities at once, and whether this is a highly localized, so, an entity with a handful of assets in a single location on the coast, or at a relatively coarse scale, so, at a state or municipality or regional scale. So as climate change is affecting the geographical dispersion of risks, that is driving a need for a greater understanding of the environmental and social context used to inform investment decisions. At the same time, advancements in technology and data science are helping to integrate satellite and other new forms of geospatial data and analyses into the finance sector, so-called spatial finance. And we wrote a paper on this in early January, rather, this year, and you can Google that. But for this work, we use satellite data and machine learning to assess whether there was any link between the locations of US public water utilities and their financial performance. And we found that the utilities that were located in regions with evergreen forests and perennial ice and snow had better all-in coverage ratios than those that were located elsewhere. And importantly, the all-in coverage ratio is a ratio of freely available cash to debt service. So it's effectively an important driver of a utility's financial profile, and entities with higher all-in coverage ratios indicate stronger credit quality. Our analysis demonstrated that some ecosystems appear to be positively linked to water utilities' strong financial performance, which was interesting in itself. And particularly over the next decade, spatial finance may enhance our ESG analyses by linking information about ecosystems and societies directly to companies' financial metrics. Next slide, please, Nikki. This graphic, so the graphics rather on this slide show 3 things. So the top shows the variation in the value of companies in each S&P index that hold assets with high exposure to physical climate risks. The bottom left shows the intensity of physical risk exposure within each index, and the bottom right shows the types of physical risks that may be important in each regional context. The analysis shows that average exposure to physical risks are greatest in the S&P Emerging Broad Market Index and S&P ASX 200, which is an Australian index, and lowest in Europe and elsewhere. And the results really show wide variation in risk exposure of individual companies within each index. So for example, the most exposed companies in the S&P Emerging BMI and the S&P Europe 350 indices, so at opposite ends of the exposure scale there, have exposure scores of up to 4 or 3 times greater, respectively, than the average index scores against the 2050 time point. So this type of analysis helps us understand the relative exposure of companies, regions, and sectors, and of course indices, to physical climate risks, including the drivers of those risks as well. Next slide, please. This is my last slide, just kind of summing up. So in summary, we've been focusing on climate risks, both physical and transition risks, for some time, and we reflect these in our ratings, taking a long-term view where we believe impacts will be material. We are continually enhancing our approach using some of the tools and techniques that I've shared to help us gain greater clarity on the materiality of climate risks. And there are challenges related to disclosure, but TCFD is effectively a step in the right direction and will help financial and non-financial actors gain greater clarity as to how climate risks will affect companies, sectors, and regions. And we are looking for entities to reduce their risks by utilising long-term planning and through increasing focus on adaptive management, particularly as we expect the critical impacts of climate change to become more severe going forward in the absence of any action. Thank you very much. I'll now hand back to Nikki.
Brilliant. Thanks ever so much, Paul. That was a really, really fascinating introduction to credit ratings and how ESG factors are considered, and yeah, really, really useful to see some of the techniques and methods that you use to consider some of those factors. Also really interesting to see some the difference in exposure to different types of risks within different parts of the world and different sectors. So thank you very much indeed for that. Now our second speaker is Nick Pyatt, Director at Trioss. Now Trioss and Nick's work within it focuses on the adaptive capacity element of climate risk, strengthening climate smart decision making, making the right decisions at the right time, and reducing the cost of acting too early or too late. Nick's work also includes work with the insurance sector, which he's going to talk to us about today. And this is working to help strengthen the value of its existing services to climate resilience and understanding how to overcome barriers that some of its business practice poses to effective adaptation. So Nick, I'll pass over to you, and thank you very much.
I think you're on mute, Nick.
Nick, we can't hear you. Are you muted?
Ah, there we are. Okay, I was muted but couldn't see how to get myself off mute. There we go. Okay, so Nikki, somehow in trying to unmute myself, I've come down a few slides. Not quite sure how to get back. You seem to be in control again. I'd like to go.
Okay, Nick, I'll just take you back to your.
Thanks very much. Maybe we should stay with the approach that Paul took.
Yeah, that's fine. We'll do that.
Okay, so thanks very much. And after that, and thanks Paul for a super introduction. So I'm going to talk about some of the experience we've got working with the insurance sector, some of the great opportunities it already has in supporting climate adaptation and resilience, and some of the challenges it recognises and is trying to address in terms of the tensions between its existing business models and what will serve better, more effective adaptation. So next slide, please. Thanks. So where does insurance fit in the climate risk management framework? Well, it's all about transferring risk, and it's a classification of risk transfer. So when we take out a policy with an insurer, we transfer the risks that are covered by that policy to the insurer. Next slide, please. And you may recognize these steps. One of the major changes of impact that comes with climate change is the frequency, intensity of extreme climate events. I'm just going to use these 4 steps in extreme event management to consider how insurance services can support climate resilience. Next slide, please. So planning. So we can, in terms of planning our risk management, we can transfer anticipated risk through insurance to levels that are available, affordable to the organisation, and in line with the risk appetite of the organisation. We can also draw on the extraordinary, the strong capacity that the insurance sector has in forecasting hazard and planning support to reduce risk through its NatCat, that's natural catastrophe services and similar services. We can also factor in as part of our planning into our capability for absorbing and recovering from extreme events, to think where we might prioritize our resources. So if insurance will replace some things but not others, we might want to put more resources into those things that we can't, protecting those things which can't be replaced through insurance. And we can also use insurability as a useful benchmark in planning and design future actions. And insurers are particularly interested in being engaged at this stage so that they can advise, these are the sorts of risks that we perceive, and this design is managing or not managing those risks in that way. So that's something they're particularly keen to do as part of planning. So next phase, please, absorbing. So absorbing, one of the things in an extreme event, those of us who've been in them, is that time really matters. And sometimes we need access to funds straight away, and some of the conventional ways of storing funds for emergencies do not release funds quickly. So insurance policies exist to allow very quick release of funds, which can then be replaced when our savings and reserves are available. We can also factor in, as we have done in planning, the issue of what insurance will replace and what it won't, as we start to hit the uncertainties and emergencies that are unexpected, that inevitably happens in an emergency. The first victim of an emergency is the plan. So when we're trying to reorientate ourselves and replan in the middle of the emergency, using insurance as a guide to where we need to prioritize resources can be useful. But policy terms may also limit our absorption, because unexpected events may not be supported by insurance, and so divert resources away from things that we had previously wanted to protect. Next slide. So in terms of recovery, well, policy payments are the most obvious way of supporting recovery. And also the contribution to recovery, but the contribution to recovery will be affected by how well the policy is aligned by the actual event. Thanks, next slide. And adapting. So once we've been through all that, we've got to work out how to adapt. And insurance, we can learn from insurance in working how to do that and working in terms of our risk transfer. So existing policy terms may enable or limit adaptation. So for instance, if replacement terms are only on a like-for-like basis, we may only have access to the insurance funds by replacing things as they were, rather than that we now understand them to be more effective. But if we've got access to like for better, so if at a household level, for instance, like for like would be, we've got to replace with a fitted kitchen. Like for better would be, we can raise the plug sockets to waist or chest height, so out of flooding range. We can replace fitted units with units on casters, so we can move them and get them out of the way, that sort of thing. We can learn lessons from the performance of the plan that we already have, including contribution and constraints to current. We can also review any changes in future available insurance risk transfer policy terms. What do we want that's different? And as we'll see later, we might find that the insurance options have changed. So we need to understand how those options have changed to see what's available as we plan into the future. One of the assets that large customers like water companies have is that they're very attractive clients. And so they may be able to negotiate terms which smaller clients may not be able to get. And that's where some of adaptation action may become a negotiating offer negotiating leverage in those negotiation terms. Next slide. So insurance and climate change. This is how the insurance sector is seeing the relationship between the two. That it can play a key role in managing physical risk, especially in face of most extreme events. But the growing physical risks because of climate change will also influence the future affordability and availability of insurance protection. And you can see this quote from the UK's Prudential Regulatory Authority. Increasing levels of physical risks from climate change could present challenges both to market-based risk transfer mechanisms and to the underlying assumptions behind general risk business models. Can I have the next slide, please? And here's an example of some of the things that, some of the business as usual responses that insurance companies have for protecting themselves from extreme events, including climate events. Now, this is taken from a case study on COVID-19, because that's very current. But actually, if you go and look at how the insurance sector is responding to extreme flooding events this year in Yorkshire, or previously in Cumbria or Somerset, exactly the same measures are being taken. So they will reduce exposure to increased costs by introducing exclusions, by increasing excess terms and increasing premiums for the future. They may also start closing any remaining loopholes on contracts that are up for renewal to reduce their exposure to any future costs. But you will also see retrofitting interpretation of policy, making sure that not only that they're not on the hook when the outbreak happened, but they won't be on the hook at all, ever. So we've got a case at the moment with one insurer that's introduced a blanket exclusion for any loss related directly or indirectly to communicable diseases in the COVID-19 case. And that includes existing policies where policyholders might have thought that that was covered. And another has tightened the rules about denial of access cover, which applies when a policyholder cannot access their business premises, to exclude the denial of access because of diseases. And the Association of British Insurers is saying that providing more coverage for future outbreaks in terms of COVID-19 would require significant state sponsorship of the insurance sector. And when we look at climate change, that's something that the insurance sector has already managed to negotiate partially in the UK. And we'll see something about that later. Next slide, please. So the insurance sector has a conundrum. Climate change is increasing natural hazards and the sorts of hazards that it's used to covering or accepting risk transfer for. And business as usual practice is actually reducing business opportunities because it's withdrawing its engagement and the services it's offering to businesses or policyholders because of changing climate risk. And at the same time, by doing that, they're increasing the vulnerability of wider society, which is not something they want to be associated with. And a key part of their challenge is that the policy only lasts for 1 year. And how do you value effective adaptive practice with risk, which is only likely to appear outside that 1 year period? If you start rewarding risk, adaptation risk for the future in your current policy terms, then the company may not get the benefit because they may not be the policy supplier when that risk actually becomes apparent. So let's look at some of the things. So yes, And so ClimateWise has been set up by the insurance community to try and address some of these conundrums. Next slide, please. So let's look at some of the things that, they're doing to consider that. So they're trying to work out what the difference of risk will be in the face of climate change. So in the UK, when we're looking at properties in relation to surface water flooding, also potentially fluvial flooding as well, their assessment is that by 2050, losses from increased flooding will have increased by 60% if there is no adaptation. Whilst there will be an increase, there will be limited to 20% increase if there is perfect adaptation. But they and many of others are aware that adaptation isn't something you just turn on or turn off. Could I have the next slide, please? So there's different levels of physical risk measures that can be taken, but they're affected by the ability and the intention of the organisation to actually manage those risks. And here's a metric which we're looking at using to differentiate different levels of risk and losses in terms of adaptive capacity. And so in this 6-level scale, level 1, if you went in and asked your boss what their how their climate adaptation plan is going, they would say, don't bother with this nonsense, I've got a proper job to be getting on with. At level 2, it would be, well, we're doing no more or no less than we absolutely have to. At level 3, they're going beyond compliance and really taking ownership at this stage and upgrading business as usual processes like risk registers, environmental or social impact assessment. At level 4, they're starting to realize that business as usual with knobs on isn't enough, but they're not quite sure what they need to do differently. And so they start engaging in some innovation to identify what those breakthrough projects are to get them to level 5, which is understanding what they need to do differently and mainstreaming that throughout the organization. And level 6 is a stretch capability level, which is about thinking beyond the interests or pure purpose of the organization. We saw that in the early stages of the Dutch adaptation program, for instance. Next slide, please. Now, if you take that spread of risk, of potential losses from flooding by 2050 and spread them evenly across those levels, those 6 levels, there's an 8% difference in loss with each of those capability levels. And that's quite a significant difference. Now, we don't believe that there is a straight line relationship, but we're about to start on some investigations to consider what those relationships might be, so that policies and advice can be guided in terms of the relationship between the quality of adaptive planning and future policy risk. Next slide, please. And I'll just quickly go through, here's a number of ways that we're exploring some of those risks, some in Somerset, some in Southwest London. We're looking at insurance, how insurance can offer advice and gain benefits from more efficient use of large-scale emergency responses. So if you see on the telly that the fire brigade and the army are out helping with flood response, the cost of that usually ends up with the insurer. So they're interested to work with partners to see how can more be done with the same and how can we achieve the same with less. And that helps, that can be reflected in insurance policies and also in terms of the cost to the insurer. We're looking at fluvial and coastal risk to existing properties. Are there ways that adaptation measures can be better affected in policies and in policy terms and in premiums? New planning decisions, really interested in that. Can the insurer be part of that planning process to guide on what would strengthen insurability for planning going forward? And an example of the vulnerabilities there, talking to a district planner recently, all planners are being forced, affected by government housing policy, to put houses on floodplains, because if they don't meet their housing targets, they will get fined and have planning controls taken off them, but they can't meet the targets without going onto floodplains. But there's a plan, talking to a planner recently, he believed that planning for resilience to a 1 in 100 year event under the current climate would mean that that site was resilient for 100 years. And that isn't how it works. And in fact, looking at resilience to increasing flooding, if in one of the major river catchments in Somerset, we look at the impact of a 30% increase in peak river flow, which is a very, very moderate climate scenario, because we need to have plans for up to an 85% increase in peak river flow by the end of the century. If we want to anticipate that risk over the life of a development, then we need to be planning to a 1 in 1,000 resilience specification under the current climate, to have a 1 in 100 return rate risk by the time we reach a 30% increase in peak river flow. So that planner is completely underestimating the risk that he has to manage into his current design. And if he can talk to the insurer and understand that and the insurance implications for the properties, then he might be able to make better decisions, and the insurer then knows that how they can put insurance onto that planned area. We talked a bit about the insurance sector having transferred risk to the government. Well, there's an initiative called Flood Re, which looks at domestic properties particularly. So the government now underwrite any flood policy on domestic policies for insurance companies. But they're going to close that by 2039. And there needs to be a strategy for trying to withdraw that state support to work out how the market can take that risk without undue exposure to hazard by domestic households, which are becoming increasingly at risk. And then the systemic risk. So business continuity, for instance. A lot of the businesses in these heavily flooded areas that we've seen on our tellies, the ones that go under or are badly affected don't get wet. It's because the communication of road diversions takes people away from the businesses, and they lose business in that way. So are there ways of engaging with some of those systemic risks and see if things like the behaviours of the emergency services and the planning to reduce problems of business discontinuity can be reflected, can be understood, and then reflected on the policies to those businesses. So that's a quick run through. So thank you very much, and I'm happy to take any questions.
Brilliant. Thank you so much, Nick. That's a really, really great set of slides for us on insurance, and very much a conundrum for, on the one hand, insurance is a tool for managing risk, but I can see very clearly from what you said that climate change and extreme weather is certainly going to pose a lot of challenge to the industry. We've got some time now for Q&A for speakers. So I think there's one question that's come from the audience, but if anyone's got any questions they want to ask Nick or Paul, then please do type them into the Q&A panel now. So we'll take this question that's come in. Nick, I think it's actually for you. It's a point of clarification on one of the points you were making in your slides. In your example about flooding in the southwest, what did you mean by perfect adaptation?
That's a really good one. It wasn't specific to the southwest. This is a general analysis that the insurance sector has done under its physical risk assessment, and it's simply I don't have anything particular in mind, but if you have an assessment which says the losses will lie between 60% with adaptation and 20%, or so 60% without adaptation and 20% with adaptation, then the 60%, the 20%, the low end probability of losses can only be achieved by whatever is possible being done. So there's nothing specific, but in the assumptions that are made in that analysis. Sorry, Nikki.
Thank you, that's great. Thank you, Nick, for that. If there is any other questions, please do type them in. If not, I've got a question for both of you, Nick and Paul, that hopefully you'll be able to answer for me. It strikes me from your presentations that both credit ratings and insurance are essentially, you know, two financial tools or mechanisms potentially for managing risks, but also providing opportunities for entities, companies, households, whoever it might be, to actually put some adaptation action in place. To what extent do you think that credit ratings and insurance will provide an opportunity or will drive adaptation action?
Do you want me to kick off, Nick, and then
you go, Paul?
yeah, fine. So I mean, it's not for us as S&P Global Ratings to, you know, drive action. We will comment on and rate entities based upon our criteria and our methodologies that are openly available and the information that's provided to us. But clearly, irrespective of that, clearly, you know, it's probably not too far to say that as entities, you know, see the kind of resilience benefits of their investments, that they may cotton on and equally start to, as we understand and get more granularity about the types of investments that are able to be made and the benefits of those, and particularly of the timeframes that we may experience those benefits. I think it's fair to say that you know, they will become more resilient, and there could be a corresponding increase or improvement in credit quality as well. Over to you, Nick.
Okay, thanks. I think one of the things is I've tried to show that the conundrum that the insurance sector has extraordinary insights into long-term hazard and its implications for its policyholders, and it would like to use that as a force for good. And so insurance companies often have a parallel consulting services which provide that sort of advice. So they're in the advisory space along with lots of other consultants. And so what they're starting to look at is the business model, which is how they remove themselves from exposure, the sorts of things that we showed in that case study. But they'd also like to work out, are there metrics that could help them to more effectively reward adaptive behavior? And sometimes that may be harder in the sort of in properties that are already existing, but they're looking at how they might do that. But there are particular great opportunities, as with all adaptation, is when we're starting to make a decision for the next phase or a new development. You know, those decision points are key adaptation opportunities, and to be drawn into conversations which allow their voice to contribute to what is locked in by those decisions is one opportunity they particularly like. So they don't have the perfect answer, and they're trying to work out what to do different.
Thanks, Nick, and thanks, Paul. And have we got any other questions coming in from the audience? I can't see any others in the Q&A section at the moment, so we have got a few minutes. If there is anything you want to ask, then do type your questions in today. I just wanted to ask Paul a question for you, if I may. You mentioned in your presentation specifically a case about heavy sort of polluters like coal power stations. I'm just wondering, how do you incorporate transition risks into credit analyses for companies, maybe things like food producers that use a lot of natural resources, water or natural resources, but maybe aren't the obvious kind of big emitters or heavy polluters?
Yeah, good question. I think heavy polluters like the kind of coal power stations have, of course, a quite significant task at hand related to kind of transition risks. So I guess it's fair to say that if an entity faces kind of natural resource stress, you know, water scarcity being a good example related to kind of power stations, this is kind of factored in by analysing the degree of stress that could occur using scenario analyses, and that gives us some kind of indication of the severity of kind of resource stress to the company, to the region, and how that can impact credit quality. but related to kind of transition risk, of course, as well. It's not just the kind of access to resources and kind of changing technologies. Another way that we could factor in those transition risks related to kind of coal power stations, maybe related to kind of policy or regulatory risks, which of course would be included as part of our analysis as well.
Great, thank you. That's lovely. Well, we don't have any other questions from the audience, so I think we'll leave it there. I just want to say a very big thank you both to Nick and Paul for your presentations. Really fascinating insights into some elements of managing the financial side of climate risk. So thank you very much indeed to both of you for that, and thank you very much everyone in the audience who's given up their time on this very warm evening. I hope you found it interesting. Just the very last thing to say is that this is the last seminar in our 2019-20 series. So we will, with the East Anglian branch, will be holding our AGM in August. So do look out for that on the CIWEM emails, and do come along and join the AGM if you're available to. Also, if you've got any interest in joining the branch committee, we'd love to hear from you, and do get in touch with myself or anyone in the Central CIWEM office. We'd love to hear from you. So thank you very much, everybody. Have a lovely evening. Goodbye.
All right.
Thanks, bye.